You're listening to Fun Shack. I'm Ross Butler, and today I'm speaking with Mike Smeed, Managing Director of InMotion Ventures, the corporate venture capital arm of Jaguar Land Rover. Mike was formerly at a Shanghai-based joint venture with JLR and a Chinese car maker, where he was Vice President of Finance, and before that he was Commercial Finance Director at Walgreen Boots. Mike, welcome to Fun Shack. Corporate venture capital is an interesting way for large companies to really get into the kind of entrepreneurial innovation end of the economy. How does it differ from being an independent venture capital in terms of how you can operate and how you invest?
In terms of corporate venture capital, there's a recognition that there's so much going on in industry at the moment. If we take automotive,
Mm.
just for a moment, there are so many, there's probably a dozen things going on in the automotive industry at the moment that taken in isolation would be industry defining, whether
Mm.
it's the move to EVs from combustion engines, whether it's the change in the way that vehicles are sold and the relationship that automotive brands want to have with their consumers, whether it's what we're seeing at the moment in terms of the growth of car companies in developing markets and the implication that that has
Mm.
in Europe. I could probably go on and talk about a dozen things, but there's a real recognition, I think, under both again within automotive, but also in the wider industry that big legacy companies, incumbent companies, can't do everything,
Mm.
and therefore a focus on where innovation is coming from, and innovation tends to happen on the periphery of organizations rather than from within, is a big focus area for businesses, and one in which by investing in companies is a fantastic way for you to get exposure into that ecosystem of innovation and in startups in particular. When you compare a CVC to a standalone VC, actually, there's a lot of similarities. If you went back probably 5, 10 years ago, there would probably be a marked difference. And CVC probably had I'd say, a negative connotation with it. There was a lot of fear about taking corporate money because you might be guided towards a particular direction. Maybe they would want to take too much power or have too much influence and guide you in a way. And also there was a fear that they might try and buy you, and that still goes on in particular areas. But there's been a real shift, I would say. I've only been doing this for 18 months. That's a big disclaimer on my part before we start. But what a lot of CVCs have done is really take on the professionalism around VC and bringing it into a corporate angle. So, in terms of the due diligence that takes place, the background checks, the focus on the right valuation, on the metrics, both pre and post deal, those are all lessons that have been learned from VCs historically. What we're seeing and what I see in my peer group at the moment is a lot of people were the heads of the fund. So the people doing my job in many organizations in the world growingly tend to be an insider. So someone who's come from the parent company to lead that particular function. But underneath that, in terms of the investment principles, the investment, directors, associates, platform, these are, very similar, if not identical roles to what you would find, in a
Mm.
VC. And also another kind of historical shift has been moving from, as we are in Emotion, we invest off JLR's balance sheet. So we're an evergreen fund. Whereas growingly, there are a number of CVCs that are setting themselves up as discrete funds. So you will see them being set up as a completely separate, fund structure in exactly the same way as VCs are, and some growing number, particularly in the US, who are taking on external capital. So not only having the parent company as an LP in effect, but also taking on external capital, primarily from financial institutions, because they got that financial lens in terms of their investment focus. So I think there's a growing convergence between CVC and VC. I'm biased naturally as a CVC kind of professional myself, but I think taking the discipline that comes from VC and applying the corporate lens to that, I think, and we're seeing particularly over the last kind of 6 to 12 months as the VC landscape has become particularly tough, that actually CVC investment is holding up in a way that's probably stronger than what we're seeing in the VC market at the moment.
So there are many ways to structure corporate venture capital. generally speaking, it's converging with the kind of independent institutional venture capital world. I guess to try and refine my very broad question, I guess it's about the mandate and how tied in with the broader strategic requirements of the mothership you are compared with, I guess, the other end of the spectrum, just how much freedom you have to pursue themes that are just very vaguely related. How does that work?
Again, I think there's a very close convergence in that. So let's start off with CVC and InMotion Ventures. We have a very strong reason to exist, and that's to invest in exceptional startups. They're going to help accelerate the pace of innovation and the delivery of our strategic transformation of JLR. So we're not a theoretical function. We're not out there doing, some eyes and ears. We're actually really looking at investing in early stage startups, which is a bit unique for CVC. Most of our peer group invest in kind of Series B and beyond. We're a seed to Series A CVC because we've recognized that that's the biggest value that we can add both to our parent company and to the startups that we choose and to work with going forward. So that strategic mandate that we have, and we invest in climate, industrial, and enterprise technologies, because those are the technologies that are really pivotal to the strategic transformation of the company. So JLR's strategy is not just a product strategy. Yes, there are, car elements to it and the vehicles that will be coming out, but actually it's more of an enterprise-wide strategy. So focusing on, being carbon net zero by 2039. So we will be tailpipe zero by 2035. So that means all the vehicles will be electrified by then. But moving into 2039, the organization as a whole will be carbon net zero. So that goes beyond purely the cars, because that's scope 1 and 2. We're also looking at scope 3 and looking at the wider enterprise completely.
I assume you're going to want to club together at some point with other venture capitalists.
Yeah, completely. So we don't lead rounds. So we're a co-investor. What we like to do is try and build up through early stage rounds around about 5% equity holding. What we believe that gives us is, from a business, it makes sure that we have that level of relationship with the business. We have the information rights, potentially a board observer role that goes with that to make sure, because we want to be a very active investor in the companies that we work with. We would have spent a lot of time diligencing the company together with our colleagues in JLR, because we have access to over 8,000 engineers and people within the UK. We very rapidly we can get on calls with them and with the startups to really understand whether this is an exception. That means that we have to be very active within the investment community and working with our CVC colleagues as well as VCs as well. So we've invested with some of our competitors. So we're investors alongside Volvo and BMW and Porsche in a number of our investments.
That makes sense, because it's not like you're operating only in a cutthroat competitive business, but you're actually operating, it's more in an industry that's being constantly disrupted at a macro level, and therefore you all share the same challenges to some degree. So then it makes sense to collaborate at the innovation level.
Yeah, completely. And again, if you go back, I mean, just so JLR this week has released its sales for its fiscal year 24, which ended the 31st of March. And the wholesale, so the cars that JLR has produced and sold to dealers, were around 400,000 vehicles for the year. So that's relatively small in a world in which there are tens, if not hundreds of millions of vehicles that are sold every year. So if I was to go to work with, or a startup was to come to talk to me, and I said that I want you only to work with JLR, then that's immediately curtailing the growth of that startup. But we spend also a lot of time with VCs, and what we need to prove to our VC colleagues is that we can add value. So we have 21 companies in our active portfolio at the moment, and 90% of those are engaged with JLR in some way, shape, or form. Now, that could be a fully commercial arrangement, such as a contract to provide breakdown services, such as Urgently in the US, or colleague bus transport in the likes of Zelo up in the Midlands. Or that could be right at the early stage of an RFI or an RFP process in with procurement. So when we talk to our VC colleagues, one of the things that we provide and CVCs provide is a real endorsement of that startup. So we've had a couple of instances particularly over the past 6 months, as we've been a lot more active in investing, where VCs have come to us and said, look, we're looking to lead this round, or, we may be invested at an earlier stage. What we would like is to go in with a strategic in terms of this round. And coming in with JLR provides that endorsement that the product or service that the company, the startup, is either producing or looking to produce and to develop is something that is required in the industry. Because as we move into the thing, I'm sure we'll get into AI and other things kind of later on down the line. But there's been a big, I think, focus of really neat solutions running around looking for a problem. Now, what we can provide, again, at that very early stage, with a relatively centralized organization based here in the UK, gives the startup the opportunity to talk to a company and typically be either their first automotive customer, or in the case of a couple of investments we've done recently, be their first enterprise company. So their investors may be all financial VCs, and we would be the first strategic CVC on the cap table. And again, that leads to what we believe is a deeper and a more collaborative relationship with them.
When you engage as an entrepreneur with an independent venture capitalist, you know what they want. They want to make money, and they want it in a certain time frame. You've alluded to a number of ways that you can be helpful to a startup company, and I guess they can be helpful to you. But is there a hierarchy of things that you are looking to get out of these investments and these relationships?
The historic view of CVCs has either been you're either a financial investor or a strategic investor, and kind of somewhere in between. And I think what we're seeing, I was at an event in California a few weeks ago at the Global Corporate Venturing conference in Monterey, and I think everyone's now starting to realize that there's nothing strategic about losing money. But there are a couple of CVCs that we've met where the guidance and the mandate they have is, look, we want you to be the eyes and ears for us to see what's developing in the market, whether that's new business models, threats to our organization, opportunities that we should be looking at, or generally just tell us what's going on in the outside world. And I don't care whether you make money or not. We've got a big balance sheet. We've got loads of cash. Please, go and just go and do that, but be the insight from the outside world and bring it back in. And there are others, again, going to the other extreme of financial investors, where we don't care about the strategic benefits. We just want to invest to make money. Again, they would typically be investing larger amounts, because we typically invest between 250 and $1 million is pretty much our sweet spot in any investment we look to make. We have the ability to go a little bit earlier or a little bit later, depending on this particular circumstance. But what that means is, by investing that amount of money for a company the size of JLR, our financial returns are not going to move the needle in terms of what gets reported in a quarterly result. However, that said, we've got to be responsible. And therefore, what we have worked on in terms of our fair financial return, is what we call it, is that we don't want to be a cost center. So what we want to make sure is that we're making sufficient return. We stay above the red line, such that when the finance team quite rightly are looking for where are we spending money, where are we creating value for the organization, we're on the right side of that line. But in terms of why we invest, there are 5 reasons why we invest. The first reason is that really investing is the gateway to the startup ecosystem. Now, you can go to events, you can go to all of these things, you can listen, and you can learn about what's going on in the outside world. But in reality, people are drawn to you if you're an active investor. And therefore, other VCs are attracted to you if you're making investments, and therefore you'll get invited to more things. The second reason then, and we alluded to it earlier on, is to bring that innovation into the company.
But on that point, my mind's kind of slightly boggling around the trade secret kind of part.
Yeah.
Because, they're an independent company, you're an independent company, you're there to gain knowledge, you're not an independent VC. It must be quite a difficult line to walk, is it sometimes?
No, it's not, actually, because the simple reason is if you step over that line, you'll only do it once.
Right.
And then immediately your credibility is ruined. So we are very clear. We are a separate legal entity. We're a wholly owned subsidiary of JLR. But what we would always insist, if needs be, that we would have a separate NDA between InMotion Ventures and the startup, and JLR and the startup. So, 3 and 4 kind of come together, which is really speed to market and cost. And those are two things which a lot of companies are kind of struggling with. And we know that, the analogies of, a speedboat and an oil tanker, or a spaceship and a horse and cart, I think are well, kind of versed. But startups definitely move at a completely different pace to large organizations. And there's a really good kind of, obvious reason for those. We're typically moving early stage, where we're helping those companies develop. We are typically their first automotive customer or investor, or their first enterprise customer or investor, completely. And therefore, utilizing the expertise within the organization helps their company develop and grow. And it helps solidify those use cases. But even going into, the facilities that we have, in our research and development centers in the UK and in Ireland, sometimes companies just want a car to play with. Now, that's something that's a relatively, inexpensive thing for JLR to have, because we have a significant test fleet. We have access to test rigs, virtual environments, test tracks, and things like that, which would be very valuable for a startup's perspective, because for them to do that privately would be, quite an expensive kind of undertaking. The fourth point around cost: investing is an incredibly capital efficient way of innovating. If I give you an example, one of the startups that we recently invested in, we invested a couple of $100,000 in a $2.5 million round. Those other investors who put the money in were financial VCs, with the first strategic, with the first automotive company in the cap table. So in essence, we're being given access to $2.5 million worth of resources for $200,000. So again, automatically, you're kind of taking your capital outlay and you're 10xing it compared to the actual value that you're getting, particularly at that early stage. Because a lot of the things that we're trying to solve, particularly in the climate space, these are issues that are going to cost hundreds of billions of dollars. Now, I don't have access to that amount. No individual VC or CVC does. So it's really important that we work together collaboratively. So point number 5 is a fair financial return. So we've got to make sure that we're making money and that these are investable businesses. We invested in 16 companies last year. We talked to 2,500. So therefore, from a business, from our perspective in the automotive space, having an innovation or a product that can only sit in 400,000 cars really limits the size and growth potential of that company. And as we are an early stage investor, by the time you get to Series B or C, then typically the check size will rule us out, and then other larger companies will come in at that point. So again, we don't want to restrict, that growth of that startup.
Just from an entrepreneur's perspective, I can see one of the big advantages with taking CVC money is that whenever you're developing anything new, you have an idea of what's going to fly, but you're constantly adapting it, because you don't actually know what a company needs from moment to moment. And to have access to people that are around that have access to the big table, and to know what's going to fly, that must be hugely valuable.
We really think that that CVC has, we call it an unfair advantage. Because again, you started off this discussion with a question about the difference between VC and CVC, and sometimes I think it's really hard to work in a VC, because again, you're very specialized, but the thought processes and the investigation you're having to do on your own. But I'm not an expert in climate, industrial, and enterprise technologies, but I've got contacts in my phone who are, and they're really focused on what are the technologies that we really need. And if I give you an example, we were talking about head-up displays. So the driving aids, when you're driving down a vehicle, typically these are things that you look down and it has your speed reflected on the windscreen. It's a very rudimentary kind of piece of tech. It's a series of mirrors that go from behind the steering wheel onto your windscreen. The actual technology that's involved in that, it's quite large. It's 20 liters in terms of the size of the unit that sits in behind the steering wheel. So what we were looking for when we made an investment in a company called Envisix, is that they're looking at augmented reality and holographic displays for head-up display, to make sure that you as a driver, you're focused very much looking out the way. you're very much focused on what's happening 2, 3, 4 meters ahead of you, rather than looking down at a very cluttered dashboard, which is what we see in a number of our competitors. Now, what was really exciting about them, and again, I go back to the exceptions. They were ticking the box in terms of the user experience, the technology, but also they were able to package this, and their third generation product is something that's going to be significantly smaller, to the tune of maybe even a quarter of the size of what the incumbents are. Now, that's something that we've invested in alongside Hyundai Mobis as a CVC. So again, it's one of those great examples, I think, of where you're really looking for those things that are really going to push the boundaries from a technological perspective, but tick every single box that you're looking at, which kind of explains why we invest in 0.1% of the companies that that we talk to on an annual basis.
I was hoping you were going to come up with an example that I could relate to, and not something in the engine, but I can definitely relate to that.
So the human machine interface is a big way, but having voice control is another perfect example. So Amazon Alexa is already available in JLR vehicles alongside a number of other iterations. So you're able to change your your radio station without even looking down or doing anything else. But again, that's another one. If I go back to the point I raised at the beginning, this is one, the technological advances that are possible. And EVs, when we look at electric vehicles, I think everyone's focusing on the battery kind of part of it, but there's so much more going along that's been enabled through telecommunication, as an example. So the 5G has meant that cars are becoming more connected than ever. We're looking at the moment at an investment in a space communications company that's enabling us to use satellite tech communication as opposed to the mobile communication, to avoid black spots. So using low Earth orbit satellites is a great way of making sure that you're always on and always connected. And going back to the days of kind of 10, 15 years ago, when your car was telling you whether you had enough fuel, whether the radiator was hot enough, and maybe if you were lucky, you had a temperature gauge, a gauge to tell you whether one of your tires was kind of running flat or not. Some of our vehicles moving forward will have 10, 15, 20,000 data points on them. So again, making sure that we or JLR as an OEM is aware of the state of health of its vehicle is going to be really important. But you as a customer and a client in the vehicle, making sure that you're always connected as well is another really important point.
But as someone that's worked in the kind of more traditional commercial and finance functions, but still looking for innovation, and now has experience within a CVC, I think I know the answer to this question. You think the CVC model is one that actually makes sense?
Yeah. For my own job security, absolutely, I would say that. Yes, it is. I mean, if you go back, we all know that real innovation is happening in outside of large organizations. That is why you see the Googles, the Metas, the Amazons of this world, who are going out and buying companies and bringing them into their organization, because that's where the real innovation is happening at the moment. Now, you can go and talk to innovators as much as you like, but you will not get invited into the inner circle unless you're an unless you're an active.
Yeah, you want to be a player.
Yeah, exactly. Because otherwise, again, and I would love to think that startups and investors are coming to talk to me because, I'm this wonderful human being with this, engaging personality that people want to talk to. The reality of the situation is that they know that, a conversation with me could end up with potentially could lead to an investment. Yeah. And that's what it's about.
Great. Well, thanks so much for coming in, Mike, and explaining all that. It's been fascinating, and good luck with what lies ahead.
Oh, thank you very much. I really enjoyed it. Thank you.
You've been listening to the Fund Shack Private Capital Podcast. Now do me a favour, would you? Wherever you're listening or watching, make sure you subscribe. It really helps, and I'd appreciate it. Fund Shack is another quality production of Linear B Group, the content and media provider for professional services and investment firms. Thanks for listening.